The Darwin Mistake. Why Australia sold its key Navy base to China for 99 years for $500 million. Hook in 2015, Australia sold control of Darwin Port to a Chinese state-linked company for 99 years for $506 million. That's roughly $20 per Australian citizen to surrender their only deep-water naval base facing the South China Sea. This is the balance sheet of a liquidation that's already complete. Picture the contract signing in Darwin, Northern Territory officials celebrating $500 million in economic development, Chinese executives calculating surveillance radius. At Australia's northern gateway facing the Indo-Pacific, 1,500 kilometers from contested South China Sea waters. The port where U.S. Marines rotate, where Australian destroyers refuel, where submarine resupply happens. All vessel movements, fuel loads, timing, now visible to a foreign operator for 91 more years. The federal government found out from news reports. Defense Department had no veto rights. The Foreign Investment Review Board approved it rapidly. The question isn't whether Australia needs that port back. It's whether anyone calculated what happens when you can't use your own naval base without Chinese surveillance during a Taiwan contingency. This is the bubble phase, false prosperity built on deferred consequences. Here's why this matters to you. When regional governments defer infrastructure investment, assuming federal bailouts will always arrive, they create hidden vulnerabilities that force strategic asset sales during the next fiscal crisis. Your defense geography gets liquidated to cover budget shortfalls. The boardroom metaphor, Australia's Northern Territory operates like a subsidiary with chronic negative cash flow. 40% of its budget comes from the parent company in Canberra. For decades, this works. The territory maintains control of crown jewel assets, while federal transfers cover the gap. Darwin Port sits at the convergence point, northern Australia's only deep-water harbour, at the gateway to Indo-Pacific shipping lanes adjacent to Robertson Barracks, where up to 2,500 U.S. Marines rotate annually. The asset reportedly generates $15 to $20 million in port fees, a rounding error in defense value, but enough to justify keeping it on the books. Nobody's calculating the option value. The port is assumed to remain under Australian control because it always has been. Meanwhile, the Northern Territory's budget deficit grows, ranging from $500 million to $700 million annually. Infrastructure maintenance gets deferred. The gap widens. The territory's fiscal structure creates inevitability. 240,000 people trying to maintain infrastructure built for strategic defense, not commercial return. Mining royalties fluctuate with commodity prices. Federal transfers arrive with policy strings attached. The structural imbalance compounds. Darwin Port requires significant expansion investment to handle projected cargo growth. The territory can't bond finance it without federal guarantee. Canberra won't guarantee it without austerity commitments. Political deadlock ensues while the asset sits on the books as non-core. This is forced lending in reverse. The territory's dependence on federal transfers creates a leverage that will eventually force asset liquidation when the parent company tightens terms. Here's what this means for you. Australia's defensive positioning in the Indo-Pacific depends on Darwin Port remaining under sovereign control with operational security. But fiscal architecture creates a scenario where regional political survival incentives conflict with national strategic interests. The port becomes a liquidation candidate because it's valuable enough to attract buyers, but commercially underutilized enough to justify selling. Other regional governments watching: Western Australia's ports, Queensland's coal terminals, Tasmania's maritime infrastructure all start appearing on foreign investor target lists. The precedent hasn't been set yet, but the incentive structure is identical. Fiscal pressure plus strategic asset plus federal regional tension equals future fire sale conditions. Britain in the 1970s assumed North Sea oil revenue would solve fiscal gaps indefinitely. They deferred infrastructure decisions assuming future liquidity. By the 1976 IMF crisis, assets were liquidated under duress at precisely the moment strategic value peaked. Australia's Northern Territory is running the same playbook. You might be thinking, but surely there are safeguards. The federal government wouldn't allow a state to sell critical defense infrastructure to a foreign power. Here's the problem with that assumption. Australia's constitutional structure gives states and territories significant autonomy over commercial assets. Darwin Port was classified as commercial infrastructure generating revenue, not military infrastructure requiring federal oversight. The Foreign Investment Review Board existed, but operated under a framework prioritizing economic benefit analysis over strategic security review. Defense Department veto rights weren't codified. The gap between what people assumed was protected and what was actually protected created the vulnerability. That was the bubble, the false prosperity where nothing happens, because everyone assumes the asset stays sovereign. The margin call is when fiscal pressure forces liquidation. This is the margin call. Here's why this matters to you. When government budget deficits exceed 15% of annual revenue, non-core assets suddenly become liquidation candidates regardless of strategic value. Your naval infrastructure gets reclassified from defense necessity to balance sheet line item. The Northern Territory hits fiscal crisis in 2013 to 2014, facing a $700 million deficit on a budget approaching $6 billion. Federal government signaling conditional bailout with austerity strings. The political calculus shifts overnight. Accept federal humiliation and spending cuts, or find alternative liquidity. Territory treasurer reviewing the balance sheet. Darwin Port generates revenue but requires hundreds of millions in infrastructure investment. Selling it for 400 to 500 million solves most of the deficit immediately without federal oversight or policy strings. The asset moves from strategic infrastructure we maintain to underutilized commercial property we liquidate. Chinese state-linked entities have been mapping Australian infrastructure for years: ports, power grids, agricultural land. Landbridge Group, whose chairman has reported ties to PLA officer networks, sees the opening. Darwin Port at fire sale timing, 99-year lease term locks in control. Australian government desperate enough to skip due diligence. The bidding process reveals a leverage asymmetry. Domestic buyers can't match Chinese state-backed pricing because they calculate return on commercial port operations alone. Landbridge calculates return on strategic positioning, surveillance capability, Indo-Pacific logistics optionality, which doesn't appear in the financial bid rationale, but drives willingness to pay premium. Territory government receives $506 million offer for 99-year lease. Commercial advisors focus on cash flow projections, not security implications. Defense Department not consulted during deal structuring, port classified as commercial asset outside military oversight. The covenant-free terms become selling point to close deal faster. No usage limitations, no federal override clauses, no security review triggers built into contract. Clean transaction, maximum upfront cash, minimal conditions. Here's what this means for you. The territory liquidates generational control of strategic infrastructure for one-time cash. Injection equal to roughly 10% of annual budget. That $506 million gets spent on current operations within 18 months. The 99-year lease, representing roughly $20 per Australian citizen, creates permanent positioning exposure for temporary fiscal relief. Your government traded naval optionality for election cycle liquidity. Federal government in Canberra realizes the deal is progressing through news reports, not formal consultation. Creates intergovernmental crisis. Do they intervene and trigger constitutional fight with territory government, or allow deal to proceed and accept strategic consequence? Political paralysis ensues. No decision is a decision to let the sale happen. U.S. Pacific Command monitoring quietly. If Australia liquidates Darwin to Chinese operator, does that affect marine rotation facility security? Intelligence sharing protocols? Submarine resupply compartmentalization? Nobody wants to publicly challenge Australian sovereignty, but strategic assumptions are being recalculated in real time. Britain in 1976. IMF demands asset sales and spending cuts as loan condition. Government liquidates British Petroleum stake, council housing, Rolls-Royce equity at depressed prices. Temporary fiscal crisis creates permanent ownership transfers. Australia's margin call follows identical logic. You might be thinking, but there's FIRB, the Foreign Investment Review Board. They review foreign acquisitions of Australian assets. Surely they would block a Chinese takeover of strategic port infrastructure. Here's the problem with that assumption. FIRB's mandate in 2015 focused on economic benefit analysis, not defense strategic review. The framework asked, does this create jobs and economic activity? Not, does this compromise naval operational security? Landbridge's application emphasized infrastructure investment commitments, regional employment, trade facilitation. Defense Department provided input but had no formal veto mechanism. FIRB. Approved the transaction quickly, faster than many residential property foreign purchase reviews. The regulatory framework was built for commercial real estate screening, not dual-use infrastructure protection. The territory solved its budget crisis. Landbridge acquired the asset. The margin call is complete. Now comes the rescue with covenants. Because $506 million in cash always comes with strings, you just don't see them in the contract. Phase 3, the rescue with covenants. This is that rescue with hidden covenants. Here's why this matters to you. When foreign entities acquire long-term leases on defense infrastructure, operational control transfers even if legal ownership technically remains sovereign. Your military can't use its own base without foreign surveillance. The contract finalizes October 2015. Landbridge Group assumes operational management of Darwin Port. The terms everyone focused on, $506 million purchase price, 99-year lease, infrastructure investment commitments, were visible. The operational governance clauses were fine print. Port management transitions from Australian operators to Chinese state-linked entity. Hiring policies, security protocols, access control, surveillance equipment installation, all now under foreign discretion within commercial operations framework. Australian Navy vessels still berth there. U.S. Marines still transit cargo. But the operations center controlling visibility into timing, fuel loads, cargo manifests, communications infrastructure, that's now managed by an entity with PRC board connections. The dual-use infrastructure becomes unavoidable. Every routine commercial operation creates intelligence collection opportunity. Container terminal security cameras capture naval vessel loading operations. Fuel farm management reveals consumption patterns, indicating deployment preparation. Port scheduling data shows force movement, timing. It's not espionage. It's inherent to operating the facility. Landbridge implements standard port management systems with one critical difference. Data ultimately routes through PRC accessible networks. Australian vessels can't berth without reservation system. Reservation system captures vessel type, arrival/departure times, cargo volume. That dataset becomes submarine deployment pattern analysis, naval readiness assessment, logistics vulnerability mapping. The covenant-free lease meant no restrictions on who Landbridge hires, what equipment they install, what data they retain, where that data ultimately flows. Defense Department realizes post facto, we've embedded foreign observation capability into our own naval logistics chain with no contractual mechanism to compartmentalize sensitive operations. Here's what this means for you. Australia cannot conduct confidential Northern Theater military operations without PRC, linked entity observing preparation, timing, and force disposition. If Taiwan contingency occurs, an Australian Navy needs to surge from Darwin without telegraphing intent, impossible. Your military lost operational security at your own base. U.S. Pacific Command now calculating whether to reduce classified activity at Darwin, which degrades the entire alliance logistics architecture both countries spent 70 years building. Five Eyes intelligence partners conducting security review. If Australia allowed this at Darwin, what's the compartmentalization integrity of other shared facilities? Signals intelligence cooperation requires confidence that sensitive operations aren't visible to adversary powers. Darwin precedent creates doubt cascade. Regional allies watching. Japan, South Korea, Philippines all have U.S. base agreements with strict security protocols. Australia just demonstrated those protocols are negotiable when fiscal pressure appears. Every ally with budget stress and Chinese infrastructure investment interest takes note. Britain, 1946. Sterling balances held by India, Egypt, Argentina, frozen, then devalued. Colonies thought they held liquid wealth. Discovered control had already transferred to London's treasury, dictating conversion terms. Rescue liquidity contained governance transfer. Darwin's rescue follows the same pattern. You might be thinking, sure, there's some commercial visibility, but actual military operations can be compartmentalized. Just don't do sensitive activities when Chinese operators are watching. Here's the problem with that assumption. Compartmentalizing operations at a port requires either removing all foreign personnel during sensitive activities, which telegraphs that something sensitive is happening, defeating the purpose, or building parallel facilities outside foreign operator view, which would cost billions and take years, negating the entire purpose of having Darwin Port. The dual-use infrastructure means surveillance is unavoidable consequence of normal operations. You can't run a naval port without vessel scheduling, fuel management, cargo handling. Those data points reveal deployment patterns even without classified details. Landbridge doesn't need to insert spies. Routine port management provides the intelligence feed inherently. Now we have to address the elephant in the room. Contract breach by Australia would trigger massive legal compensation. Billions in present value calculation of 99-year revenue stream, plus PRC trade retaliation targeting over $150 billion in annual bilateral trade. Political cost of admitting mistake and paying buyout exceeds any government's willingness to act. The vulnerability. Nobody wants to be the politician who spends billions to fix a deal that looks stupid only in hindsight. The rescue phase is complete. Operational control transferred inside commercial management framework. Asset stripping is where we see what actually gets extracted beyond port fees. This is asset stripping, but intelligence assets, not financial ones. Here's why this matters to you. Strategic infrastructure's real value isn't port fees, it's positioning optionality. Landbridge now controls surveillance platform at Australia's northern gateway during the exact decade when Indo-Pacific becomes critical theater. 2016 to 2024. Landbridge operates Darwin Port within legal contract terms while extracting intelligence value that never appeared in financial projections. Australian government slowly realizes the transaction's second-order effects as geopolitical environment shifts. South China Sea tensions escalate. Artificial island construction, 9-line enforcement, Taiwan Strait crisis frequency increases. Darwin Port's strategic value, dismissed as abstract concern during 2015 sale, becomes concrete as U.S.-China military posture hardens. Landbridge's routine operations now occurring in context of heightened Indo-Pacific surveillance. Every Australian naval vessel movement from Darwin gets correlated with satellite imagery. Every U.S. marine rotation cargo shipment photographed. Every submarine resupply timing logged. Commercial port management becomes dual-use intelligence feed during the exact period when that intelligence is most valuable to Beijing. The extraction happens inside contract compliance. Landbridge installs upgraded port security systems, cameras, sensors, communications infrastructure, all justified as commercial improvements, all creating enhanced surveillance capability. Port expansion investments include new facilities positioned for optimal visibility into naval berthing areas. Australian Defence Force must continue using Darwin. No alternative deepwater port exists in northern Australia. Relocating operations to Cairns, roughly 2,000 kilometers southeast, or Perth, over 3,000 kilometers west, degrades response time for Indo-Pacific. Contingencies. Strategic geography forces continued use despite compromised operational security. U.S. Pacific Command quietly adjusts protocols. Most classified submarine activities shifted to different facilities. Some marine rotation logistics rerouted. Intelligence compartmentalization increased for Darwin-based operations. This degrades alliance efficiency. What was integrated logistics architecture now has trust gaps requiring redundant infrastructure. Here's what this means for you. Australia's ability to respond to regional crisis degrades because its own naval base is compromised. If China moves on Taiwan and Australia needs to surge forces rapidly without telegraphing intent, can't happen from Darwin without PRC observing every preparation step. Your military's response time advantage in the most likely conflict scenario just evaporated because of a $506 million port sale 9 years ago. The strategic optionality you need in crisis is gone for 91 more years unless you buy it back at multiples of the original price. Other Chinese infrastructure investments in Australia under new scrutiny: electricity grid stakes, agricultural land holdings, telecommunications equipment, university research partnerships. Darwin Port becomes precedent case for delayed regret. Deal looked economically beneficial at signing. Strategic cost only visible years later when geopolitical context shifted. Parliament begins discussing FYRB reform, expanded federal veto powers, lease buyback options, all after control already transferred. Regional allies recalculating Australia's reliability as alliance partner. If Canberra allowed this at Darwin, what prevents similar vulnerability at other joint facilities? Trust deficit doesn't break alliances, but forces redundancy planning that wouldn't otherwise be necessary. Hong Kong, 1984 to 1997. British firms liquidated Hong Kong assets ahead of handover, transferred capital to Singapore and London, left infrastructure shells. By 1997, UK had extracted movable wealth. China inherited fixed assets with embedded surveillance. Same pattern, liquidation, masked intelligence, positioning gain. You might be thinking, even if there's surveillance, it's just one port. Australia has other bases, other infrastructure. Surely the strategic impact is limited. Here's the problem with that assumption. Darwin isn't just a port. It's the only deepwater harbor in northern Australia facing the Indo-Pacific theater, making it irreplaceable for regional operations. Building alternative facilities would cost billions and take over a decade. During that period, Indo-Pacific could see Taiwan crisis, South China Sea escalation, or other contingency requiring immediate Australian response from northern position. You can't replicate strategic geography. Darwin's location, at the Northern Gateway, adjacent to U.S. Marine Rotation Facility, at the convergence of trade routes and defense positioning, makes it singularly valuable. Losing operational security there isn't limited impact. It's losing your only northern logistics hub during the exact period when you need it most. Asset stripping complete, intelligence value extracted legally while Australia watches, unable to reverse without massive compensation. The balance sheet is the final reckoning. What the liquidation actually cost versus what was received. This is the balance sheet, the final reckoning. Here's why this matters to you. We're 9 years into a 99-year lease. Australia received $506 million in 2015 and surrendered positioning optionality worth orders of magnitude more. The transaction's true cost only becomes visible when you need the asset back and realize reversal is prohibitively expensive. 2024 perspective, Australia spent the $506 million on current operations within 18 months. That money is gone. What remains? 91 years of Chinese operational control over northern naval logistics during the highest stakes Indo-Pacific military environment in 80 years. Parliament Debate 2024. Multiple parties now proposing Darwin port lease buyback or forced termination. The numbers become clear. Buying back the lease at fair present value, calculating 91 years of port revenue plus infrastructure investment plus contract breach damages is estimated to cost $5 to $10 billion. That's 10 to 20 times the original sale price to fix a problem that shouldn't exist. Landbridge operating profitably, port fees, infrastructure investments yielding return, strategic positioning value to PRC far exceeding commercial return. They have zero incentive to renegotiate terms. Australia has zero leverage to force renegotiation. The contract is ironclad. The lockdown mechanism, 99-year lease, creates generational fait accompli, where reversal requires either paying massive compensation that no government wants to justify to voters, or contract breach triggering trade retaliation from a bilateral partner representing over $150 billion in annual trade. Australia's options in 2024: accept status quo and live with compromised operational security at Darwin for 91 more years. Negotiate buyback and pay billions for assets sold at $506 million. Political humiliation admitting the mistake. Legislate termination, breach contract. Trigger legal damages plus trade war with largest trading partner. Build alternative and spend billions on new northern deepwater port. Takes 10 to 15 years. Doesn't solve existing exposure. Every option costs far more than the original $506 million received. This is the liquidation's true balance sheet. Here's what this means for you. Australian taxpayers will either pay billions to fix this or accept permanent strategic vulnerability. If buyback happens, you're funding hundreds of dollars per citizen to reverse a transaction that generated roughly $20 per citizen in original revenue. If buyback doesn't happen, your military operates under foreign surveillance at its most critical northern base during peak Indo-Pacific tension for 91 more years. Either way, the 2015 decision to liquidate strategic optionality for temporary fiscal relief will cost generations of Australians. International precedent now set. Other nations with budget stress and strategic infrastructure can observe that Australia sold Darwin Port to China for $506 million and spent years unable to reverse it. Every government facing fiscal crisis can rationalize similar transactions. Australia did it, and they're a major U.S. ally, Five Eyes partner, developed democracy. The precedent value to China exceeds the port's commercial value. It demonstrated that allied nations will liquidate strategic positioning under fiscal pressure. FIRB reforms passed 2020 to 2021 to prevent future Darwin-style transactions. But reforms don't affect existing contracts. The warning came after the vulnerability materialized. Britain, 1976 to 2000. IMF loan conditions forced privatization of British petroleum, council housing, utilities at depressed prices. By 2000, UK calculated the true cost, privatization programs that generated immediate revenue but significant foregone income over subsequent decades. Temporary fiscal relief created permanent wealth transfer. Balance sheet reality becomes undeniable. You might be thinking, this is fixable. Australia just passes a legislation terminating foreign ownership of critical infrastructure, pays fair compensation, problem solved. Here's the problem with that assumption. Fair compensation for breaching a 99-year lease means paying present value of all future revenue that Landbridge expected, plus consequential damages, plus infrastructure investments made in reliance on contract. Legal experts estimate billions minimum. That must be approved by Parliament, justified to voters, and funded from current budget during other spending pressures. Then there's trade retaliation risk. China could target Australian coal exports, barley, wine, education services, tourism, a substantial bilateral relationship at stake. No Australian government wants to trigger that fight, especially when the immediate benefit is avoiding hypothetical future security crisis rather than solving current visible emergency. The political incentives ensure inaction until crisis makes reversal unavoidable, by which point costs will be even higher. The complete liquidation sequence, bubble of false prosperity, margin call, forcing asset sale, rescue, transferring operational control, asset stripping, extracting intelligence value, balance sheet revealing true cost. Australia sold 99-year control of its only northern naval base for $506 million during a regional budget crisis, created permanent strategic exposure, and now faces 91 years of compromised operational security or massive buyback costs. Same contract, same port, different geopolitical reality. The Darwin port liquidation represents the full sequence. Bubble creates vulnerability, margin call forces sale, rescue transfers control, asset stripping extracts value, balance sheet calculates cost. We're 9 years into 99-year lock-in with 91 years remaining. Australia traded Northern Naval Positioning optionality for temporary fiscal relief worth roughly $20 per citizen. The pattern says once you complete the full liquidation, reversal requires either crisis, forced buyback at 10 to 20 times cost, or acceptance of permanent strategic exposure. The mechanism is locked in. The question is whether Australia pays to break it, or lives with compromised operational security until 2011-14.